Now, if you haven't realized, the stock market just crashed a little on Friday last week. The S&P 500 was down by 3.4% to 4,050 points. The NASDAQ index was down close to 4% and went back to the $12,000 range. So just when you thought we were about to end the month of August with a positive gain, then you realize that we have just went back below the first August index points balance. And all the unrealized gains that you have enjoyed during the August short bull market run just vanished out of thin air. So what really happened, right? In this video, we'll talk about it. So from what I gathered using my Seeking Alpha Premium subscription, which you could get it for $99 for 1 year using my link, the Fed chairman Jay Powell just said this on his Jackson Hole speech on Friday. The main idea of this speech was that Jay Powell was very clear and concise on what the Fed wants to do, and the main thing is to curb inflation to a 2% level. So in order to keep to that low inflation rate of 2%, the Fed will likely need to keep raising the interest rates, and interest rates will continue to stay really high for some time. And the other thing was that the Fed do not want to go on a stop and go approach, meaning that they do not want to see the situation then decide what's the next course of action. They want to really take inflation head on, and that will means they are really hawkish on their sentiments because they really want to fight the inflation. As history has proven that if you really take a stop and go approach, it may lead to a far worse impact on the economy. So the takeaway from this message is that there is really no soft landing here. There is no hope of cutting the interest rates for the near term because the Fed is already determined to keep the interest rates as high as it is to curb inflation. And that will mean if you hope that the market will be green by the end of this year, it will be a very low possibility. And that was why the market reacted really negatively to it, right? It was a really bearish message set out by the US Fed, meaning that whatever that we have hoped for the interest rate cuts during the month of August when we see the market strongly rallying, is all gone because there's no hope for the market. The Fed already said what they need to say. Now, how about Singapore's inflation then? If you do read Sidley like me, you realize that the year-on-year increase on headline inflation as well as the MAS core inflation has increased to a new record high. In fact, in July, our headline inflation rate was 7%, and even the core inflation rate, which excludes private transportation like your cars and your rental, is up 4.8%, so it's really bad on the inflation side. Meanwhile, if you look at specific categories, your highest inflation rate are on transportation as well as your food prices and clothing. All this has increased more than 5% year over year. And you know, as we are coming to the end of August and entering September, you'll remember that September seems to be the worst month for stock markets. Because if you refer to the historical study, you realize that September will average a 1% fall in the index. In fact, if you look at the past few most severe market declines during September, you realize that most of them are during a financial crisis, such as the nearest one being the 2008 global financial crisis. And if you remember during last year in September 2021, the S&P 500 index indeed dropped a 4.8%, which was a fairly huge drop month on month. And even some people in my Telegram group were really upset and angry about it. So of course, you can join my Telegram group down below to see the market sentiment of how the general population think as well. But you know, past performance is not an indicator of future performance. History does not repeat itself, but it tends to rhyme. So you really cannot time the market. Like I said, last year, it may be a really bad month, but this year, who really knows, right? It may rally in the middle of the month. I know you folks are tired of seeing Weibo ads because you are smart people. You have gotten your free Apple shares and free Microsoft shares since the last few months. But you know, there are still some people who are clueless and haven't got their free stocks from Weibo yet. So this month, Weibo is actually offering you $100 worth of Google shares once you have deposited $1,965 and make 6 buy trades. And in addition, you get $8.88 worth of Meta shares for the current promotional add-on offer. The other condition is that each buy trade has to be at least 100 USD, and the condition is that you have to hold your $1,965 for at least 30 days until the stock voucher is credited. But you may ask, why such a funny number, $1,965? It is to signify Singapore's years of independence since 1965. Happy National Day, and as a channel with SG in its name, very proud to be a Singaporean, so I hope that this $100 worth of Google shares can make your day better. And that is so we can be stronger. Majula. So once you know that the US Fed is really hawkish on the market, they are really taking drastic measures to curb inflation, and you also know of this like September curse, then what are you going to do? Now, I can't tell you what you're going to do because that is financial advice and I'm not giving you financial advice, but I'll be sharing what I'm going to do, right? The first thing I'm going to do is reduce any margin, any leverage, and any borrowing to zero. And I'm talking about bad debts. Now, with the rising interest rates, if you're holding on to long-term debt that is not a good debt like property mortgage, then I think it's really unfavorable to you, right? If you're borrowing money to really buy other things and the interest rate is rising as you know it, then your interest expense is just going to be higher, knowing that the interest rate is going to increase. And for those people who borrow money from the bank or their stock brokerage to leverage on their stock picks or their stock portfolios, then maybe it's a really bad idea because the brokerage firms are going to raise their interest rates as well. And therefore, you're going to pay a much higher interest expense just to finance your stock trading or investing. And also with the rising interest rates, the stock market is most likely going to go into a negative zone, right? Negative return zone. So you see, coupled with the interest expense, the additional interest expense, plus your negative unrealized losses, is going to be a double whammy, right? On one hand, you are losing to the interest expense. On the other hand, you are like getting unrealized losses increasingly because the market is not doing well in your favor. So really cut any margin, cut any borrowing that includes your options trading or derivatives that involves leverage as well. Second thing I'm going to do is to continue dollar cost average into the index funds. Now, these index funds includes like the S&P 500, the MSCI World Index, and of course the NASDAQ 100 ETF. Why I still continue to dollar cost average is that I really admit I cannot time the market high and the market bottom. I really want to take advantage of any time the market could flip to the other direction. And if you really miss it, you will miss out on a great potential gain, right? Because you just missed the market bottom. So I really cannot time the bottom. I will just continue to dollar cost average into the index. I need to stress this because if you dollar cost average into the individual stocks, it is a much higher risk because you're betting that this one single company is going to do well in this downturn. But if you are betting into an index fund, then at least you know that some companies may not do really well, but the other companies can help to take the better share out of it. And the third thing I'm going to do is to build up my cash position to take advantage of the market. The best time to buy is when there is blood on the streets. Right now, there's no blood on the streets yet, but I can see that we may go into this potential blood on the streets event. So during this very difficult period, try to build more cash surplus, save up more money, build up your cash war chest to really put out the bucket when it's raining, right? And of course, when I'm talking about any surplus, this is after you have done your regular dollar cost average automatic investing, right? That's what I did in point 2. So really, these are the above 3 points that I will really do it myself and follow through it. And it's really 3 simple steps, right? But do you know that simple does not mean it's easy? Just because these steps are really easy to do, that does not mean that it is easy to follow, because I know that the market will really affect your emotions, be it going up or going down. So it's very important to know what you're doing and follow through these 3 steps. And if you really want to know how do I dollar cost average my investments using the most cost effective platform, be it cash or CPF investments, then take a look at this video right here where I show you how I invest my $4,000 monthly.